joined by Abhay Agarwal of Piper Serica. He's founder fund manager at Piper Serica, joining us this afternoon. Abhay, great having you as always. Abhay, one of the trends we spoke about last time, and always good catching up with you, was the EMS space and the entire import substitution opportunity. That certainly has played out beautifully, right, over the last month or so since we last spoke. Still value, you believe? I'm sure it's a multi-decadal opportunity, but timing it is also fairly important, right? You can't be buying it at egregious valuations and holding on to it just because you're holding on to it for a decade.
Yeah, good afternoon. Thanks for having me.
Good afternoon.
You're absolutely right. I think it's a tough balance for investors to say, look, great long-term opportunity, but how much of the current valuation is already borrowing from the future? Because that's where your returns that you generate even over next 5 years, 8 years, 10 years get decided. I would say that this is still an emerging sector. Some of the companies are still small cap, some are mid cap, maybe a few are in the large cap zone. So there is plenty of opportunities left for investors. Our approach has been that we do not want to pay more than 2 times price earnings to growth for these companies. So if they get overvalued, we would wait and watch. What happens is that since these are small cap companies, at times when liquidity dries up in the markets, you get an opportunity to add them because there could be a sharp correction. At the same time, we don't want to be fully opportunistic. So it's a balance that we need to maintain, that look, we continue to own them in our portfolio, but we use every dip as an opportunity as long as the core business is strong. As you said, Harsh, that there is this is a decadal opportunity. I mean, so much of electronics that we import is going to convert into indigenous production. There is IP, there are big moats, competitive edges here that these companies have built. So these are not models that can be replicated easily because there is core intellectual property that is driving this manufacturing. I would still stay on the buy side, but I would not completely ignore the valuation. As a rule of thumb, 2 times price earnings to growth, I think, is a good benchmark to have for investors.
Times peg. Understood. Abhay, the other thing that's played out beautifully is some of the mid-cap banks. Now, you were focused more on the small cap end. Small cap hasn't done much over the last month or so. Would you believe good opportunity continue to accumulate because growth is coming back, and very likely asset quality will hold this time around, in fact will improve this time around, and therefore this could be an opportunity which could well unwind once the numbers start to trickle through, you reckon?
No, absolutely. I think the opportunities for investors are when there is low participation, and I think low participation comes when a sector has disappointed for many years. And I think with small banks, mid-sized banks, NBFCs, we are in that zone that while people are cautiously optimistic, they are not ready to participate because we have seen multi-years of underperformance. But I think the worst as far as balance sheets, asset quality is concerned is behind us for two reasons. One, the competitive lending that was going on has stopped. It's not that banks were running to build book and price themselves of the book growth. That metric has completely gone away. I think the NNPAs and GNPAs are at 5-year low, what I can say, and improving from here. There is no predatory lending that I can see. I think liquidity is ample in the ecosystem. So what will define now the winners over laggards, I think, is just pure competitiveness that these banks and NBFCs bring to the table. If you see the large banks, the credit deposit ratio is still challenged. They are almost 95, 96%. That means they're not able to generate deposits to match the credit demand. I think that is where the small banks and mid-sized banks have a great opportunity to be more competitive, which they already are. So they are offering much higher rates on deposits, much higher rates on FCNRB deposits, mopping up deposits at a much faster rate than private banks, able to deploy them in a positive credit demand environment. So I think investors are going to be spoiled for choice in the small and mid cap bank space and even in NBFCs. And I think this whole sector will outperform the Nifty over next 12 months.
And Abhay, I need to take a pause on this conversation because Ultratech's numbers are flashing at the bottom of the screen. 5,016 crore is where the EBITDA number has come in at. 4850 was where where it was expected in, and you can see the spike in the stock price because of the beat that Ultratech is delivering both on top line as well as EBITDA. I believe even PAT is actually a beat essentially to the expectation. So it's a strong set of numbers, and you can see the spike 2.25 higher on Ultratech. Abhay, I know you don't talk stock specific, but cement as a pack, is it something that that you're bullish on?
Well, again, this has been a segment that hasn't done well, low participation, and I think there are worries. There were worries about the whole monsoon impact to construction, but I think most of it is overdone. I think cement is a very critical part, just like other ferrous metals for core infrastructure development. So I would stay cautiously optimistic. We are not really investors in this segment per se. We are more of growth investors. But it is good to see that these companies are outperforming on analyst expectation, because that sets a more optimistic tone to the entire market, and also gives long-term investors a belief that infrastructure is being developed and these companies are able to generate profits, which kind of justifies their capex plans going ahead.
And Abhay, the last we spoke, you were also bullish with regard to auto ancillaries as a pack. Again, you've seen very decent run up, and there are some companies like the likes of GNA Axles where they have an exposure more to the CV side of things, where the numbers have been outstanding, right? As they've started to trickle through. I mean, it's very few numbers to go by, but what is the tilt like within the auto anch pack? What would you prefer at this point of time?
No, I would stay away from OEMs, not because I don't think OEMs will not do well. They'll definitely do well, but as investors, we have finite capital, so we always try to find better opportunities. I think the whole auto ancillary and auto component, these are the two segments that we track, are in a purple patch right now. Not only domestic demand but global demand. They're able to meet a lot of companies that have invested in R&D, product development over the last 3-4 years, built great manufacturing capabilities, acquired plants overseas, are seeing very strong demand environment, and a demand environment which is very profitable. So we are very bullish on the whole component and ancillary space. But I think investors would need to make sure that they are looking at companies which have gone through a gross block increase over the last 3 or 4 years, because these are the companies that have a very strong operating leverage as their numbers go up. So I would say that this, rather than the OEMs, I would stay on the side of companies that are building complex electronics, display systems, complex forgings for the international auto market, whether it's CV, PV, two-wheeler, the emerging space of EV mobility. I think this is a great space to be in, Harsh.
Uh, Abhay, I'm sorry, but I'm going to have to pause this conversation, switch out. Abhay Agarwal still with us, and thank you, Abhay, for waiting by so patiently. Unfortunately, perils of news, right? But give us a sense. How should one look at IT? I know you're not particularly bullish on IT, but you have to say that it's an opportunity to pick winners, right? Whether you're picking it or not, I'm not so sure. If so, how? Is there a view there?
No, we track the sector, but still early to say if there are any winners. I think the whole sector right now is moving towards becoming system integrators of various technologies. from software development, application development, the business models seem to move towards taking various pieces of technology. Some of it is AI, some of it is non-AI, some of it is enterprise SaaS, and stitching complex solutions for large enterprise clients. Now, that is a business which has challenges because it is not as remunerative. Your margins are going to be lower compared to 20% plus. It will be 12 to 15%. And in that case, the valuations, P multiples, which were all 25 times plus, will all adjust downwards to 15 times. So I think there is, unless companies come out and start talking about changing their business models, it's very difficult to see where is growth going to come from, because it's not going to come from pricing for sure. Pricing will be under pressure. It is not going to come from volume because none of these companies are now hiring anymore. So where will, as an investor, I'll make return coming in at this price? So unless I get an answer to that question, Harsh, I think we're going to stay away for the time being.
Yeah, I mean, super interesting because I mean, rarely have we seen large cap IT trade at sub 15 times earnings. I mean, it's a totally new world, right, Abhay? The last piece, Abhay, is private sector banks, and you've stayed away from the larger ones. And by private sector banks, I meant the larger ones. You've stayed away from them, and correctly so. Would you tactically buy them on dips? Because now these also aren't trading at particularly expensive valuations. It may not require too many triggers for a bit of a run-up on some of these counters. Give us a sense as to how you're looking at this space.
Yeah, Harsh, I think this space is something that, again, we look at it. But since we are growth investors, unless we see clear growth and unless we see price earnings to growth ratio that is favorable, we would not look at it right now. And I think my problem with the large banks is continuously their lack of competitiveness. And that lack of competitiveness has led to this situation where their credit deposit ratio is 96% or thereabouts, which means they're just not able to get the deposits, create liabilities to build assets. So unless they fix that, unless they become competitive, unless they are competitive in terms of generating the FCNRB deposits, where some of the international banks are offering leverage of 19:1 to generate these deposits, I don't see where will the growth come from. Again, it's easy to predict growth for banks because your liability book increases and then your asset book increases, and then you get into that virtuous cycle. Unfortunately, the 3 or 4 large private sector banks are not in that virtuous cycle. Asset quality is not an issue, but it's just that where is growth going to come from? And then you look at a situation where the price to book multiples continue to be the highest in the world. So I think this is a space that will probably reward investors, but I don't think the time to buy them is now.
Okay. Abhay, thank you so much for joining us and giving us that perspective. Of course, conversation interrupted, but nonetheless, the takeaway is taken home. Thank you.
Thank you.